Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll provide an update on recent market activity and discuss how investors can not only keep perspective, but take advantage of opportunities. The current market pullback is a result of concerns around the potential recessionary impacts of tariffs and possible trade wars. These concerns have spread around the globe, with markets in Asia and Europe declining alongside U.S. stocks. If we take a step back, it's clear that successful investing requires a combination of both offense and defense. Defense involves holding a balanced mix of assets that can withstand changing market conditions. Offense, on the other hand, depends on opportunities that emerge as market conditions change. Over the next few minutes, we'll discuss how to think about playing both offense and defense in the current market environment. First, in this chart, we can see the historical minimum, maximum, and average return ranges for various portfolio allocations and time periods. This highlights that as time horizon increases, return ranges become more stable. It also shows that more diversified portfolios experience narrower ranges. Notably, while many downturns occurred over the past century, there have been no 20-year periods since World War II with average annual declines for stocks, bonds, or diversified portfolios. The same is true for many asset allocations across 10-year periods as well. While the past is no guarantee of the future, the overall pattern here reflects the most important principles of portfolio construction. It's important to stay diversified and maintain a longer time horizon. So, what does this mean for your portfolio? While pullbacks can feel painful in the short term, the goal is not to seek the highest possible returns with excessive volatility, but to achieve your financial goals with the highest probability. Next, this chart shows the VIX, a measure of stock market volatility, alongside one-year forward returns. It shows that volatile periods are often when the market is at its most attractive. This is because the VIX often spikes during sharp market drops. And these periods, when investor anxiety is at its highest frequency, precede potential opportunities in the market. Warren Buffett noted this pattern in his famous philosophy to be fearful when others are greedy and greedy when others are fearful. While this doesn't guarantee quick rebounds or mean that investors should focus on trying to time the market, it shows that even times when the market is doing poorly can be opportunities in the long run. Rather than retreating during downturns, investors should consider how periods like this can present attractive valuations that could warrant shifting toward and not away from the market, depending upon individual circumstances. Finally, pullbacks can make market valuations more attractive. This chart, which tracks the S&P price to earnings ratio using forward earnings estimates over the next 12 months, shows that valuations have been driven up in recent years due to the strong market rally, but have begun to fall in recent weeks as the market pulled back. This has made the market valuations more attractive. The S&P 500 PE ratio has declined to 20.7x, while technology, communication services, and consumer discretionary sectors have seen even more significant compression. This is a reminder of the importance of diversification. Even traditional safe havens like gold have experienced volatility, while bonds have been a valuable portfolio stabilizer, helping to offset declines in other asset classes. By being prepared, investors can capitalize on opportunities that emerge during periods of fear. We hope you found these insights helpful. If you would like to discuss this market turmoil, specific assets, or your portfolio in more detail, please don't hesitate to reach out. We look forward to speaking with you.